Investing in the stock market is one of the best ways to grow your wealth over time. While it may seem intimidating at first, understanding the basics can help you make smart, confident investment decisions. Here's a step-by-step guide for beginners to start investing in stocks. 1. Understand how the stock market works. The stock market is a place where investors buy and sell shares of publicly traded companies. When you purchase a stock, you're buying a small ownership stake in that company. As the company grows, its stock value increases, allowing you to profit. You can also earn money through dividends, which are regular payouts from certain companies. 2. Set your investment goals. Before investing, define your financial goals. Are you investing for long-term wealth, retirement, buying a home? Do you want to earn passive income through dividends? Are you aiming for short-term gains by trading stocks? Your goals will determine your investment strategy and risk tolerance. 3. Choose a brokerage account. To start investing, you need a brokerage account. Some beginner-friendly platforms include Robinhood, simple interface, no commission fees; Fidelity, great for long-term investors; TD Ameritrade, educational resources; Webull, detailed stock analysis tools. Sign up, fund your account, and you're ready to start investing. 4. Learn different investment options. There are various ways to invest in the stock market. Individual stocks, buying shares of a single company, e.g., Apple, Tesla. Higher risk, but potential for high returns. Exchange-traded funds, ETFs, a diversified collection of stocks, like the S&P 500 ETF, SPY, which reduces risk. Mutual funds, professionally managed funds that pool money from multiple investors. Dividend stocks, stocks that pay regular dividends, such as Coca-Cola or Johnson & Johnson. For beginners, ETFs and index funds are a great starting point since they provide diversification and lower risk. 5. Start small and invest consistently. Instead of trying to time the market, start with a small amount and invest regularly. The best strategy is dollar cost averaging, DCA, investing a fixed amount in stocks or ETFs every month. This reduces the impact of market fluctuations and builds wealth over time. 6. Diversify your portfolio. Don't put all your money into one stock. Diversification helps reduce risk. A well-balanced portfolio may include technology stocks, Apple, Microsoft; healthcare stocks, Pfizer, Johnson & Johnson; ETFs for stability, Vanguard Total Stock Market ETF VTI; dividend stocks for passive income. 7. Avoid common investing mistakes. Don't panic sell during market dips; volatility is normal. Avoid chasing hype stocks without proper research. Stay patient. Investing is a long-term game. 8. Keep learning and stay updated. The stock market changes constantly, so continuous learning is key. Follow financial news, study company reports, and stay updated on market trends. Resources like Yahoo Finance, Investopedia, and The Motley Fool can help you stay informed. Stock market investing is one of the best ways to build long-term wealth. By starting small, investing consistently, and diversifying your portfolio, you can grow your money over time. The key is patience, education, and staying committed to your financial goals. Are you ready to start investing?